Testing 1, 2. Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room. Live streaming from TicketTacker. Let's take a look at the TradeStation robot here. The board is showing gold at 17.15, down about 230. We're in a kind of a choppy, fast market conditions, and I'll get into it a little more. Silver is up, back up at 26.05, down about 13 cents. Copper up about 2 cents at 4.03. The mini S&P is at 39.0650, up 33 points, up about 80.85%. And we have a slightly lower derivative markets in metals. Kind of a quiet day here, but I want to take a look at, once again, the focus on the metals here. And see what's in store for us here. So bear with me 1 second. We're looking at the gold chart, currently trading at 1714.40 here, down about 280. And I want to focus on pretty much what the market is doing in terms of the signals that we're looking at. We saw a low of 1673.30 yesterday at about 9:15 a.m. and we pointed out, if you take a look at our video, the market is or was, I should say, at this point in this area of accumulation of supply that it identifies. And what we saw here is what the AI anticipates, is that we're going to see buyers show up here. And do not sell if you are taking, especially a long-term position. If you're trading, scalping, maybe you want to take the risk, that's up to you. But understanding that mathematically the probability levels here to go short are only 10%, I leave it up to you to take that trade. I, as a self-directed individual trader, what I want to do is I want to look for the highest probability trades, particularly trading in the futures markets. And because what you're looking at in terms of identifying the risk, measuring the risk, you're measuring the risk within the futures contract. If you're doing a stock, you're measuring the risk on a stock. If you're doing an ETF, you're measuring the risk on an ETF. You don't buy those based upon the direction of move 100% of the time, because each instrument has its own variables. For example, sometimes the gold market in the futures markets may go up, but the shares don't go up, they come down, or they do the inverse. And so what I believe is important is that you get an idea of the direction of the trend, for example, in gold, and obviously with the fundamentals that we have right now, the idea is to get long on the gold market. I have a lot of questions being asked in terms of, where do I get long? How do I get long? Or I got long before and I'm down 100 grand. So executing your trade has to be completely independent, to me, of anything else fundamentally. And so I look for a tool, and I, as a trader, obviously, one of the things that made me create this trading tool for myself was the fact that I wanted to become independent of the chatter, what I call, which is what you hear out there. And I keep referring to the January 6th period of Wall Street Silver that put out, Wall Street Bets put out $1,000 silver call, and it was the top of silver at 30.43, I believe was the high that was made that day, and we've reverted back from 30.35, which was the high made on January 31st, to where we are right now, which is basically what the market is telling us, is that this is the area for you to buy. When it's in blue, it identifies the area where it is the highest mathematical probability, where it's the extreme below the mean. And the probabilities at that point, particularly for the buy one level, is about 90% probability that this is the area where we can potentially are going to find buyers. So the market comes down, it completes the targets below, it trades below the average, and then it goes down to the extreme below. And you can see the buy one level of the 25.33 area, more general, begins the area of support. The AI transforms this one-dimensional pivots into a more active algorithm that, once again, it tells you mathematically, do not go short here. You only have a 10% probability if you go short. Wait until the market either comes down to activate, complete the pattern of the levels below. And in this case, it's the buy two level of 24.65. And below that, we have 24.37. So when you come in as a day trader and you come in at this point and you have no position, that is your starting point. Zero, neutral, is where you begin always as a trader, regardless of what position you want to take, whether it's day trading, swing trading, or position trading. In terms of what I do, I identify every step of the way into a pattern, a structure, a very specific mathematical structure. And what you see here on the board is basically the structure. If you look at the daily levels, we use a perfect Fibonacci 5 level. We don't use more than 5 levels. We don't need to use more than 5 levels. It's a perfect Fibonacci number. It's a prime number. And Within that number, we can identify the wave counts. We can identify the support resistance levels. We can identify the extreme below and above the mean, mathematically speaking. And we can identify the standard deviation of the average price in relative to the extreme above or below that average price. So it's an incredible amount of information which is simplified into 5 lines. If you're day trading, it gives you a structure of 5 levels. So one of the interesting things here that I want to point out, first of all, besides the fact that the market found the buyers as it was anticipated, and it found aggressive buyers that drove the price from a low of 24.84 all the way up to 25.92. This is from 6 a.m. to 2 p.m. on the 7th of March. This is the energy that validates the algorithm. So it completed the target because if you're trading it, then it tells you, buy above the buy one, your target is the mean, or the level above, and your protective level is the level below. So if you made this trade, you completed, when you get to your neutral zone, you go neutral. When you get to your average, you go neutral. You don't trade. You wait again for the highest probability trade, and that's either going above the mean or going below the mean. In this case, the market activated a bearish price trend momentum by closing below 25.65 on the 7th. Automatically, this signal activated the extreme below the mean targets. And on the weekly, it activated the 24.37 signal, which is the buy one. So on this signal, the probability was that the market can come down to 24.37. When we incorporate the daily numbers in between them, we find that the nearest level of support on the daily is 25.33, and that's the indicator that we use. And the nearest indicator will tell us the energy of the market that transforms that short-term indicator into a longer-term indicator, or a daily indicator into a weekly indicator. And if the market trades above the weekly average price, like you see here happening, it gave you another buy signal here at 6 p.m. on the 8th at 25.38. Automatically, the target was completed, the level above, regardless when you're looking at a target, whether it's daily or weekly. So, but what I want to point out to you here, this is the strongest optimal mathematical relationship that we can find in the code, in the VCPMI. When the daily price is harmonically aligned to the weekly, it is the most optimal level to expect a reversion to unfold into the bigger price ranges, into the bigger price fractals. So what we have here is that not only have we gotten a daily buy trigger, but we have gotten a bullish trend momentum daily and weekly, confirming that daily trigger. And also that the selling pressure that you saw here was overcome by the buying demand that you see here, that actually took out all of this supply that was sold here. Now we're activating a bullish price trend momentum. The target is 26.40.46. That's the nearest target, the sell one level. Right above it, we have the weekly 26.70. So in this case, what you're looking at is the daily and the weekly activating both signals simultaneously, which is a really strong signal. And it gives you the targets for the weekly at 26.70, and it gives you the two daily targets at 26.43. I'm sorry, 26.46 to 26.91. And it is as clear as, adding 2 and 2 equals 4. Just that you can add 1, 1, 1, 1, or 2 plus 2, or 3 plus 1, different varieties, but you get to the same answer. And to me, as a trader, I didn't need to have all these complicated charts, all these complicated indicators to get to the bottom line. There are certain indicators that I use and that are very close in terms of the momentum indicator of the VCPMI, which is Bollinger Bands. Bollinger Bands, Fibonacci sequences, Fibonacci retracements. These are all the other indicators that I overlay on my position. So right now, for day traders, basically, you are neutral. You completed your pattern from below, okay? And so you're waiting for a signal now on the futures. Now, to open this up a little bit more into a swing or a position trading objective, and if we take a look at the market a little more closer here. In looking at the daily chart, you can see the market came down below the support trend line that I use as well, overlapping all these other indicators, because what we're looking at is the descending channel. This is the, I believe, bottom of the descending channel that we've been making since the high was made. At 2089. And the daily gives us a little better picture here. 2089, which was made in August of last year. And it's taking almost a 61.8% correction, retracement, Fibonacci retracement to complete this pattern. And what I see here is that the market has aligned, the price actually has aligned with a number of independent different indicators that confirm the completion of this correction. When you go down to that 61.8% correction from the high to the low here, you're talking about the golden ratio. You're talking about the extreme below the mean, that if the price of gold is going to revert, it's going to revert from here. There's a possibility that you're looking at 71.2% retracement, I believe that would put us down into that 1630 level, I believe. Or we're looking at, no, the 78.6 is 1576, which in a bull market, even if the market comes down to this 78.6% Fibonacci retracement, it's still in the uptrend is still intact. And unless it closes below it, then this whole bullish pattern it will be negated. Now, that's just, taken into account, obviously, the Fibonacci retracement. So what you can see here is that I lay over the codes, the variable changing price momentum indicator, and I have the daily, I have the weekly, I have the monthly, and I also take a look at the annual, at the cycle, and I align the price and see where it is in relation to all these levels. And when I get a cluster like this in blue, in a cluster in blue into a golden ratio completion, into a harmonic alignment at what I call triple threat, which is basically aligning the daily, the weekly, and the monthly, and eventually we bring in all the annual and the cyclical. In fact, what I'm going to do is over the next couple of days, I'm going to prepare and see where we are in, pretty much in relation to all the cycles here. It's because I think that we might have completed pretty much this correction here, and that's what pretty much we're trying to identify, so that we can get aggressively long cover 100% of our short positions and get committed to the long side, which is what I'm looking to do. And so far, it appears that this signal yesterday at 1714 confirmed, and I did a comment that if we do close above the 1713 level, that it brings in the shorter term weekly moving average. But we came down here, as you see, to a monthly buy one level that coincides with a 9-year cycle of 1673, that coincides with the golden ratio Fibonacci retracement, and it's a conversion of very powerful indicators, ladies and gentlemen. That if you just take a look at the indicators and you put away the chatter, this is where you want to get aggressively long. So from now, obviously, it's a question of what instrument is going to lead the way. Is it going to be the futures? Is it going to be the shares? Is it going to be the ETFs? Is it going to be SLV? So I'm pretty comfortable holding and adding to these levels here a long-term core position in the market, which is what I've been doing all the way through, even on this correction. And, we have come down, we have experienced a drawdown into this correction, and it's expected. But I look at the market from a bigger perspective than just short-term trading. In fact, what I recommend my traders in my private trading room is that when you have a successful trade in trading in the futures markets, take that money and put it into a long-term derivative investment without the risk of margin, and continue to do that. You make you make a couple, you make a couple of grand profit on a day trade, or you take that and you boom, you go in and you can put it into GDX or SILJ, or again, measuring your risk tolerance, which is important. You can find some of these instruments accordingly. I think we got a very strong confirmation today and a follow through from yesterday's action, confirming pretty much that we've come down to a long-term 9-year cycle signal by trigger, a monthly buy one level. And we begin to put together, the complete picture, a daily trigger, a weekly trigger. So that begins to cement, you might say, the confidence level for me that regardless of what I hear out there, I adhere to the directions of the VCPMI. And I, keep saying that this is like a GPS for your trading. Let's take a look at the trade station board here and watch the platform here for a little bit. Watch the robot here for a little bit, and watch some of these other markets as well here. The gold and silver, as you can see, are trading above the average price, and it's in a bullish price trend momentum, and it's 2646 is the target above. One of the markets that you want to also start paying attention as we come back into the economy here is copper, basically. And we definitely have a strong, solid handle of $4 per pound. So you want to keep an eye on that. The E-mini S&P is taking all this stimulus very positive, and we've seen a target completed up into this 3902 level. That seems to be activating a short trigger here. We completed bullish patterns here in terms of even the mini S&P. So if you're long and you came into this day long here, this completed the target at 39.06, and we're looking more like a bit of a short-term short trigger here on the mini. It's already underway. It looks like it came in at about 7 a.m. So it's into the signal for about 30 minutes, and it went short at 38.98. There's only so many markets, that one can trade, and because within particularly the markets that we focus on, which is gold and silver, we have a lot of derivatives underneath the market that we trade. And depending upon my goal in terms of how I want to take a look at the market, short-term, long-term, or build a long-term position, then I can use the signals accordingly. Bitcoin continues to defy gravity, so to speak, and we're looking at the market here. Trading at 51.63, up 252 as well. The dollar index is at 91.91, and the dollar index is getting a lot of attention, obviously, because of this rise in interest rate that we have seen on the 10-year note, and it's supporting the dollar, which has been a little bit bearish for gold and silver. But it looks like the 10-year note has come down here to 154 from 162.4, I believe, was the high made just a few days ago. And we're beginning to, or I should say, the majority of people out there are beginning to see how this is affecting pretty much the rest of the markets, or if this rise in interest rates is going to be of a long-term duration here. I apologize for being slow here and showing you this. We are at 154.70. So we've reverted back down under 160, which was the element that was causing a lot of stress in the market here, and across the board in the bond market, equities, and pretty much every class asset that is leveraged, and that's the problem. I think that most of the economy is highly leveraged. Let's come back to the gold chart here and to the Thinkorswim platform and take a look at the mini here. The signal is actually a little bit deep into the signal, and whenever you get a signal like this, if it activates it and it's too far from the initial entry point, it's best just to pass the signal and wait for the next one. So gold is trading at the weekly average of 1313 now, which we pointed out above all the other averages. And so it's a question of time. And as I said earlier, when you are around the average price, go take a cup of coffee, take a break, let the market chop around there until it defines pretty much the pattern. And, when you're taking a look at the pattern, I think what you're looking at is the path of least resistance is the market is going to test that 1730. Very quiet day again. With an upward bias, definitely with an upward bias. The silver is trading at above 25.77, and that is, again, a very strong harmonic level that getting through that becomes a major level of support. One of the instruments that we've been trading pretty actively is GBTC or Bitcoin using GBTC, which is the Grayscale Investment Trust. It's a great tradable instrument, but it is an extremely volatile instrument. And I think you can clearly see that the market seems to be in a potentially five-way pattern completion here. We made a top of 58.22, came down to a low of 43.80, which is a really phenomenal level of volatility when you're talking about trading an asset of this magnitude and price. And went back here into the sell one level or close to the sell one level of 51.98. That basically is recommending, again, that if the price comes up to these levels here, that you want to be looking for supply to come into the market, for sellers to come into the market. This area here is the strongest area where you will be able to see supply or sellers come into the market. So far, the high of 58.22 is holding, and it's right into this area of distribution of supply. The one to watch is pretty much the gold market here. You're looking at the daily chart, and the daily chart is activating a bullish, as I said, price momentum. It's I think this is like a spring coil pulled back or a pressure cooker in price, because in fact we are looking at a shortage of physical silver. You cannot, for right now, get small denominated coins or bars in 100-ounce bars in silver or gold. My understanding is that if you do want that, you need to pay a big premium, and you got to wait a long time. I don't think that yet we have seen the pressure, you might say, or demand in the 1,000-ounce bars. There seems to be still some available, but I think the key to this whole short squeeze basically is that as we move into the economy, back into the economy, and we will, and we're about to do that, there are certain dynamics that we are uncertain of. And one of them primarily, obviously, is the tremendous demand that it's going to be created by going back into the economy. And at what pace are we going to be getting back into the economy? Now, how does that translate to silver? Well, silver is one of the most interesting precious metals because it has different applications. You can trade it as a commodity, you can trade it as a speculative vehicle, but it is the essential foundation of the monetary system that has been disregarded since 1971. For thousands of years, whenever there's been uncertainty in the monetary system, we have reverted back to gold and silver for thousands of years. And as we move into this new monetary system, which still has a lot of questions to be answered, we're going to see, I think, eventually the real demand look back at silver, or pretty much gold, as money. What is ironic is that I am telling my traders, my subscribers, to take US fiat currency and go buy real money, to show you the dichotomy, you might say, of where we are between the physical market, which is the real money, that's been money for thousands of years. And, I don't care what anybody tells me. For me, it's going to continue to. When I can put in my hand a silver coin as opposed to a mouse, it makes a big difference in terms of identifying what is money and what is not. And I believe the moment pretty much has come that the focus globally is going to be looking at silver as real money. The fact is that you're going to have a problem getting it, the real money. Is all the paper fiat currency, in existence, and even if there are defaults in some of these contracts in physical delivery and the comics, they'll settle it. They'll settle the contract in fiat currency. So physical silver, physical gold has become in very, very high demand. Money, real money, has become in real demand, not the US dollar. The US dollar is imploding. as we speak, as they are issuing the checks to Main Street, it is imploding. That very same check that you're going to deposit in your bank account is being depleted by the mere fact that the government is giving you that money for free. Somebody has to pay the piper. And so they don't care, at this point, based on the economy and where we are. Their goal is to print as much as they can to get us out of this mess, to get us out of this black hole that we're in. That I don't think we've come out of it economically. We may be looking to come out of it in terms of the pandemic, possibly a little more freedom, but economically, I don't think we've seen yet the damage of what the pandemic has done. In the mortgage sector, there's still, I believe, close to 8 to 10 million people unemployed. And so, obviously, they want you to feel that we're coming back to an incredible economy and it's going to be greater than ever. And but you're going to have to pay for it because everything is going to be so expensive. It's going to be pretty expensive. I mean, the government is indicating that inflation is below 2%. Without including energy and the food prices. When you take a look at shadow stats, when you're taking a look at the economy, when you take a look at the old CPI formula, which included energy and food prices, inflation is running at about 8 to 10%. The real inflation, the real cost of money, the real cost of prices. And that's how we are going to pay for all of this stimulus. The 10-year note, the interest rate markets are beginning to react to this possibility. That's the reason why rates are moving up. You see, that's the reason why the 10-year note is moving up, because the 10-year note cannot afford to have interest rates go up against it because it will implode the system. Most of the leverage money and hypothecated money is in the 10-year note. And we really don't know how many times it has been hypothecated, resold. As government bonds, as government paper, as government treasuries. And now we're looking at the debt exploding, literally exploding as we begin to unleash this stimulus campaign once again. That what we're going to see is that this $1.9 trillion that is being handed out is not going to be enough. And I think we have yet to see, again, the ripple effect that this had economically on those 10 million people, their homes, their jobs. So it's a new economy completely, a new market, a new world that we're moving in, which is a combination of the old economy to a certain degree and the new economy, which is virtual. And now we're moving into a system where we got to adjust and recalibrate and see how many days you're going to go to work in the office or how many days am I going to work from home. Schools, how many days you're going to work at school and how many days you're going to go to school at home. It's a completely new environment. It's a completely new world that we're moving into. And so I think when all is said and done, I want to be able to have the security that gold and silver does give me personally anyway. in being in this market, in trading in this market. It takes into account pretty much everything else that's going on everywhere else. It becomes affected eventually into the price of gold because it is a major part of the economy as an indicator, although many people don't want to admit. They say it's an old relic and, yakety, yakety, yak, but uh, I think you want to ask those people that in Venezuela especially had gold in, or Vietnam when, you know, uh, we went to war with them. Gold, it's got an incredible flexibility. I believe that eventually people realize that it is real money. The problem is it's bulky. Silver, buying 1,000-ounce bars, it's bulky. You can't carry it around with you. So, but it's begun. I think it is, and it's going to be a bigger part of the system, the monetary system, as we begin to recalibrate into this new system, and people begin to realize basically that silver, number one, is the most undervalued asset of all class assets. Number one, $26 an ounce is probably the cheapest asset out there when you take a look at the potential, the upside potential, which we're talking hundreds of dollars. People out there are looking, and the Reddit crowd at $1,000 silver, potentially it can happen. Anything is possible now that we have this new element of players in the market. So let me come back here for a minute, and I want to give you my personal opinion about this, okay? And that is basically, again, that I think we are probably days, maybe weeks away from probably one of the biggest rallies in the gold market. I think the market is biding its time and price, cyclically speaking. And not only are we coming into a cyclical signal into this period, but we're coming into an extremely oversold condition, which is supported by other indicators that I pointed out. The golden ratio, Fibonacci retracement, and the harmonic relationship, basically, of all of the time frames that we're looking in terms of the VCPMI. So I would say to you that if you had any interest, idea, or we're looking to know when is the time to get into precious metals, I think that you're looking at finally the bottom of the market. I think we've made the bottom of the market last week, and in silver as well, you can see we're looking at pretty much the same pattern. Just on the daily chart in gold, you can see yesterday we had a major key reversal day from these indicators that we pointed out to you. So continue to be patient, continue to buy into this level, and we will continue to update you here live in Ticket Talker. Once again, thank you for the time that you are allowing me to share this with you, and I hope this is helping you in becoming a better trader every day that you come here. Have a great day. Have a great week. We'll talk to you soon. Take care.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
And welcome to another edition of the Ticker Talker Spotlight here on Ticker Talker TV. I'm Bill Barr.